Hey, we're going to get rolling here this week. We've got a supply demand report out this week, so we plan on coming back again here on Thursday. But we really try to stay consistent on bringing you these Tuesday webinars. So we're going to bring a few things to the table in here, but we'll be back again at the end of the week. Like we've mentioned, this is report week, and historically, this December crop report, it doesn't have many changes to it. Okay, we're not going to get a change in U.S. yield. It's a little bit too early in the year to really make some changes in South American production. But if we do see some minor adjustments, we think the USDA could increase corn demand by bumping up the ethanol a little bit. But on the same token, when we flip over to beans and wheat, they might be a bit overstated on exports, and we could see a slight decline there. As we look back at the past few days, we've had some markets that have been some big movers in here and really want to bring those to your attention. The first one we want to look at is natural gas futures. And as you can see on the chart in front of us in here right now, over the last week, we've had February natural gas go from around $5 down to around $3.75. This is a big drop. Okay, we want to bring this to your attention because as we get into a market where we see a little bit slower demand and a bump up in supply, things can roll lower in a big hurry. The other thing is this follows up from the previous couple of weeks. We've talked about fertilizer prices, more specifically anhydrous, and how sometimes it can correlate to the natural gas market. So on the fertilizer side of it, if we have natural gas futures dropping off 25% in the value, we think we can see the same thing occur, over on the occur on the anhydrous market. That would bring anhydrous, let's say, from $1,200 a ton down to $900 a ton. This is a big break in natural gas over the last week. And to put it in perspective, looking at corn and soybeans, this would be like taking the corn market from $6 a bushel down to $4.50, and then beans going from $12.50 down to $9.50. This is some extreme volatility in here right now with this market rolling lower. Taking a step back, though, and looking at a weekly natural gas chart, our two horizontal lines are between 250 and 350. And looking back the last 7 years, you can see we spent 70 to 80% of our time in that range. It looks to us that this market is going to move back down into that trading range. A hot market, though, recently, has been the cattle side of it. We've recently had front month cattle trade to $1.40. And that's the highest trade in nearly 5 years. And the cash market is the one that has really been that upside price leader in here. This cattle market is looking good, but we do question in here how much further we really need to push in here. We've been positive on the cattle market, just sitting in here at current values. You wonder if you're fully valued in here right now, even though supplies will decline into 2022. This has been partially a demand-led market in here with strong box beef values. They have softened up recently. Like I said, we still like cattle longer term. It just looks a little more fully valued to us. As we flip over to the feeder cattle market, what we want to point out here is we're at our highest level in the last 5 years. But when you look out to the fall month feeder cattle contracts, we have October feeders right around $1.80. You can see where that reflects to on this chart. This is something cow-calf producers, as we head into spring calving, may look at this and saying, this is a pretty good value to protect. As we wrap this week up in here right now, and looking towards the supply demand report on Thursday, we think the pressure heading into this report is on the bulls in the market. And the pressure is on the bulls because they do have a big net long position in the market and therefore needs a little bit of fuel for that fire to keep this thing going. If we're going to move higher in here right now, it probably is going to get led by corn with increasing ethanol usage, and you better not see much of a drawdown in the bean export forecast on either beans or wheat. Getting back to corn, though, we think the big thing with the corn market is where crude oil is trading. Crude oil's had a nice recovery in here to start this week. Now, what is this range going to be on crude oil as we move ahead? Are we going to make new highs and trade $80 to $100 on crude oil? Or do we settle into a $60 to $80 range? If crude oil settles into a $60 to $80 range, it'll be tough for corn to go above $6. Again, crude oil, though, is the inflation bet in here right now, and that can offer some support on corn. I don't know if it can support it all on its own, though. Corn needs to do something by itself as well. As we move towards the end of the year, we're just a little fearful of a risk-off attitude from investors in here. And if that occurs in here, we just won't have that new buying to step up to the plate. to push us into new highs. That's a little bit of a concern in here as we get past the supply demand report and look towards the holiday season. We'll be back here again on Thursday and here to update you on that supply demand report. Thanks for tuning in. Have a great day.